Welcome to Brendan. We met about 18 months ago. He was one of the speakers at our Market Outlook event at the start of the year. And Brendan's based in New York and couldn't be better timing for coming over here. We've just had the US-China trade ceasefire, 90-day pause on the tariffs. Before we go to Brendan, and I promise it will be worth the wait, I want to just hear from the audience with the blue and red cards. Do you think this 90-day pause is a short-term effect in blue? Or with your red card, if you think it's going to have a longer-term positive impact on the two economies? Looks like red. Okay, interesting. Brendan, why don't we hand over to you? What's been happening? Talk us through the latest.
Well, I mean, first and foremost, thank you so much to be back in the beautiful city you call home. At that event, it was really a very pessimistic time. That the Chinese market had 3 years of double-digit negative return, and since January of last year, it feels like the market's flat. That you've had these kind of rips followed by dips, that the market rallies and it feels like two steps forward and two steps back. But the reality is the market, out of January of last year, it rallied out of that and it faded. And then in September, we had the big Chinese stimulus really geared to real estate and addressing the real crisis they're having there. And the market rallied and then it faded. And then we had DeepSeek in January and the market rallied. And then we had Liberation Day and the market fell and then it started to come back. And so net, you'd say, gosh, the market is flat or down, but it's up a lot. It's up over 50%. And again, it might not feel that way because of this two steps forward, two steps. It feels like two steps forward, two steps back. It's really two steps forward, one back. And that's where if you're actively rebalancing between these moves, it's actually been a really good environment. And again, that's where the one investor who loves China are technical analysts, because they would say higher highs and higher lows is an uptrend. And that is what's happening. And around the trade war and this 90-day truce, I was thinking, being here in Singapore, Lee Kuan Yew and Donald Trump have nothing in common. I mean, literally nothing, other than maybe one thing, which is they're pro-business. And Donald Trump is pro-business. And, he acts irrationally on purpose because rational people don't know how to deal with a crazy person. He uses chaos to his advantage. He associates with some, Neanderthals. I'd like to see Peter Navarro's degree from Harvard, because that, strategies that replicate what caused the Great Depression or the 1929 stock market crash. Like who would rationally, but the hawks they have a place. They have a place that if you're going to negotiate, like when John Bolton said that the United States should actively use nuclear weapons on Iran. And then when the US went to Iran, Trump brought, can you imagine being the Iranians and John Bolton walks in as part of your negotiating? It's a tactic. And I think you're seeing the pivot that, Tim Cook went and met with Donald Trump and said, an iPhone in the US is going to quadruple in price. And what immediately happened? The tariffs on electronics were lowered. 3 weeks ago, the CEOs of Walmart, Target, and Home Depot went and met with Donald Trump. And lo and behold, what happens? A trip to Switzerland. and obviously I don't know what they said, but my assumption is they would say that they said, we are going to run out of the cheap stuff from China Americans love by, at some point in June. Two-thirds of the US economy is consumption expenditures. And who has more to lose in a trade war? The economy that's two-thirds geared to the consumer, or the Chinese economy, which I think export-driven manufacturing is not. They're far less dependent today, uh, particularly to the U.S. than they are in the past, and that explains, both sides do need each other, and I'm hopeful this 90 days leads to, I call it a positive path, and a positive path, could have, I think, far-reaching implications, and I think is arguably underestimated by markets.
I think there's a lot to unpack there, and I'm excited to dive into it with you over the course of this evening. Why don't we focus on that tariff truce for now? Zooming out a little from the 90 days, what do you think President Trump's end game plan here is?
I think there are several strategic industries that Donald Trump wants to see to bring it back, and you know, are you going to bring back rare earth processing? Smelting, no. I mean, there's no appetite. Americans outsource their pollution to people in China, to people in India. And that way we have great blue skies. But are you going to bring back lung cancer and asthma? Like, I don't think so. So they've said there are a few strategic industries where, you know, the supply chain issues, from COVID, steel, aluminum, semiconductors, are going to be made in America. And some of that's for national defense purposes, but there's a whole host of stuff that you just couldn't do it in the United States, just labor costs, energy costs, the environmental consequences. And so this broad-based bring it all back is just a misnomer. I think it's part of that distraction technique. So yes, you're going to see these key strategic industries, but otherwise, and I'm sorry, healthcare is the other one. A lot of medicines, and that's where it's kind of funny that there are a few Chinese, particularly Wuxi Aptec. They actually have manufacturing facilities in the United States, and when that headline came out, they actually rallied on the news, and then I think the thing that is missed is, can Chinese companies manufacture in the U.S.? CATL's CEO offered President Biden to build a factory, and Biden said no. And I think, what a big, beautiful trade deal might look like could actually involve, paving the way for some of the Chinese manufacturers to actually do it in the U.S.
I guess only time will tell. You teased a little on the impact of these tariffs, this ongoing trade war between the two countries. Before we dive into that, and at danger of becoming a game show host, let's get those cards out again. Which of the two countries do you think will be most severely impacted by these trade war talks extending? Blue for the US and red for China. Looks like a pretty strong answer for blue. I guess they read your newsletter.
Yeah, I mean, this is some of the work we've done, and part of the problem is, if you publicly profess that you don't read, it means you don't do a lot of research. So I think, going into the trade war, you probably should have done a little research from the U.S. side, but I think the Chinese government did a lot of research going into it, and in general, China's dependence on the U.S. Has declined pretty dramatically. More importantly, is just in general, China is so much less geared to export-driven manufacturing. Where I think the average American thinks all 1.4 billion people in China are sitting around and making these, and they all end up in the U.S. I mean, I and that's just not true. That the percentage of China's GDP geared to export-driven manufacturing has gone from 36% down to 19%. So it's 19% of China's GDP. But what we did was then say, let's strip out things that don't really require manufacturing. So like agriculture, or, if you're just mining coal, you know, and so that gets China's, so there's actually this economic term, the value of export manufacturing. So that's 11.5% of China's GDP is this value added manufacturing. And then the US is about 15% of where China's exports go, which means you're looking at less than 3% of China's GDP is explicitly geared to the US. Now, yes, there's trade that comes through here in Singapore or Hong Kong. So I think it's probably a little bit bigger, but you contrast that with the US, where 2/3 of GDP is driven by consumer consumption, which means the U.S. is at significant risk. The other factor is that the trade war it's very specific on goods. And a good is by definition something like, using my phone again, that this was made in China by a U.S. company, manufactured by a Taiwanese company, and then put on a boat or a plane. And so this is considered a Chinese export, even though all of the money goes to a company based in Cupertino, California. And so that's where this is. There's two elements to that. One is a good, is something put on a plane or a boat. And it doesn't include things that don't require that, like financial services or lawyers. And so services are not included. And why is that? Is because the US is the largest exporter of services globally. So Trump, it's a goods trade war. It's not a goods and services trade war, because then people like China could say, well, why are we allowing Goldman Sachs or Morgan Stanley in China, or all these law firms? Um, you know, so that's not going to, Trump doesn't want that to come up. The other thing is similar to this, is that I think part of the misnomer is that the Chinese government considers this a U.S. export. Even though this is made in China, it's made by a U.S. firm. And if you take the Nike factories, you take all the U.S. companies that run manufacturing in China, and then sell that in China, or then it ends up in broader Asia, there is no trade deficit. And it's such a simple like calculation. But that is, again, it's the details that, again, it's a goods trade war. And that's where I think it's part of why the Trump is pivoting to resolve this, or starting down that path, is because there's a lot more levers China could pull. I mean, going after services, going after the U.S. companies that manufacture, that becomes highly problematic. And then that's part of, if you're worried about, the which stock market has more to lose, I'd be like, oh, well, what's in the S&P 500? Apple, Tesla, NVIDIA, Qualcomm. My favorite is going down to Texas and telling people from Texas, ExxonMobil makes more than 10% of their revenue in China. I don't own China as a fallacy because the S&P 500, according to Apollo, it's 1.1 trillion of S&P 500 revenues come out of China. So there is no such thing as EMX China, or I don't hold China because of the U.S. multinational revenues.
Got it. I think that 2.3% number versus the 10 and the even bigger numbers through the S&P, that's going to be quite some cards that China are holding. This could, of course, get a lot messier. Kenny went through at the start the poll we did with you, the blue and the red balls. Fortunately for me, we won't get my maths degree out. It was a pretty clear win. What do you think the outlook for the US and Chinese equity markets is?
It's I don't root for U.S. stocks to go down. I mean, I don't view the world as this black and white, or you win, I lose. So hopefully U.S. equities do fine. At the same time, I think the an effect that's underestimated. And I was in Europe 2 weeks ago, and people were like, I mean, these were investors would say, you know, our country fought with you in 2 world wars, and this is how you're treating us. This poor guy Pierre in Canada, was, booking his, ticket to Ottawa. He's about to become the leader of Canada, but because he was lean pro-Trump, Carney got elected, and you're seeing that play out in Australia. So national pride, is not unique to the United States, and I think there's a lot of people are voting with their dollars. That there's about 17 trillion of foreign capital invested in the U.S. stock market, and I don't think that goes to zero, but I think people are taking profits, and it's coming out, and it's going to go back into European equities. It's going to go back into emerging markets, or Singapore stocks, or Chinese stocks. Tuesday night, MSCI, the big index provider, they've got their big index rebalance at the end of the month. And my little joke is like, everyone has a favorite finance book, but the most important one is MSCI's index methodology, because it dictates almost 17 trillion of active and passive assets. And at the end of this month is this big rebalance. And at the start of the year, the US was 66% of global equities, and now it's under 62. China's went from 24% of EM to over 29%. So it's a little bit, I think it really is happening that investors, for national pride reasons, are moving some piece of money out of US equities. I think further afield is if the Fed cuts rates, the dollar weakens, and that becomes a headwind for foreign investors. And the US dollar, as well as US stocks have done for the last 16 years, the US dollar has been a huge tailwind. And if the Fed starts cutting, the dollar is going to fall. The real risk to US equities, is that at what point do people care about, the debt, the US government debt at 36 trillion? And being in DC last week, there's no fiscal conservatives in either party. I mean, forget Doge. It's a rounding error. It's spend, 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 and that number is only going to go up. This. I mean, I'll benefit from Trump's tax bill, but my kids will pay for it. So anyway, at some point, that music stops. But I think you see money coming back. For China, I think it's the deep seek moment, that it proved that China can innovate, and if they can innovate as well as the U.S., you're still paying 40 times for NVIDIA sales versus Alibaba at 14 times next year's earnings. I mean, that's the that's just where the valuation game, comparison comes in, and China is very inexpensive.
Good to know someone also has the MSCI index methodology on their nightstand. Just 200 pages. It's a light read.
To 207. But if you have trouble sleeping, just pull it out and you'll be out cold fast. It's yeah.
You mentioned their valuation. Maybe we can talk a little more on that, and perhaps as well any thoughts on DeepSeek.
Yeah, I mean, I think I think the DeepSeek moment shows, just you had as much as Trump is a business person, business interests had no place in the Biden White House. There's no communication, no dialogue with China. There was no effort. It was a stated policy to try to hurt China economically, technologically, and it completely backfired. I mean, I feel bad for Apple that they created Tim Cook's worst nightmare, which is Huawei now makes better phones. The ProMate 60 Plus is a better phone than an iPhone. But also, if you're going to curb exports of semis, they figured it out how to do it without it, and so that just is a crack in the pillar of American exceptionalism, and it forces the valuation comparison between the two markets, and so I think, yeah, I think that's a little bit of what's happening is this revaluation of like, and of course, I'm jinxing myself because Alibaba's financial results were a little off. But the stock has done really, really well. Tencent and JD on Wednesday and Tuesday had good numbers. Um, and that just again, it provides the fundamental basis for why, cheap China tech maybe versus expensive US tech. And I actually was looking at this, is that, Alibaba, it's too bad. Like, they did 997 billion RMB for their calendar year. So they just missed doing a trillion. But that's double from 2020. But the stock is still $120 below, 120 US. It was 250, and today it's at, it was at 130 yesterday. It's selling off. But how is it that the revenue it went from 509 billion to almost a trillion, to almost doubled, and the stock is down? But it's even, 10 cent, revenues doubled and the stock's flat, but some of the other names, Quashu and Bilibili have doubled revenue, and their stock went from 250 to 50 and 120 to 20. I mean, so, yeah, I just feel like, an element is just, obviously there were policy errors in China, zero COVID, the real estate crisis, internet regulation, and to earn back that trust, that scar tissue, um, which I've felt personally and professionally, it's going to take time. Which is why I think it's I'm constructive, but I think it'll take time for investors to come back into the China space, and that's probably a good thing.
Got it. Yeah, we have a long-term focus in our core portfolios, and I think that's something that's needed with this particular story, right? The fundamentals continue to look good, but the rally in terms of how long it lasts, and it can leave us questioning at times, I guess.
Yeah.
What do you think could be the real catalysts here in the short to medium term for China?
I mean, I think this re-rating is happening, and I think it's starting. I mean, and I can try to show. It's with the companies themselves. So Alibaba, they reported that they spent $12 billion buying back their own stock. They bought back 150 million ADRs in the calendar year, but you see that from all of the companies in the space. And why I think that's interesting is because these are tech entrepreneurs, and the founder of all of the companies we hold, KWeb is, our China Internet Fund's our flagship fund, but all of those companies, the founder is the CEO. And so if you thought your company was about to, I call it a Thelma and Louise, go off a cliff, you'd be hoarding cash, not buying back stock. So they think their company is cheap, and I think that's why they're buying back stock hand over fist. The other real buyer of Chinese equities, particularly the growth names, are Chinese investors in China that we can track their activity through the Hong Kong Stock Exchange. This is called Southbound Stock Connect, and year to date, investors in China have bought just about 80 billion US of Chinese stocks in Hong Kong, and they're disproportionately buying the growth stocks. And you can see that's year to date, it's double what they did in 22 and 23. And again, I think some of that might be because if the Chinese government is going to offset a trade war, they have to raise domestic consumption. And so I think this re-rating process is happening. I think it's happening with investors in Asia. It's happening with investors in Europe, investors in the commodity world. That if you're an institution in Mexico or Chile or the Middle East, you know China really, really well. But why I think it's early days um, is that particularly in the U.S., China is still uninvestable. And this is from a firm. It's from a New Zealand firm, a New Zealand-based firm called Copley Fund Research. They give away a lot of info for free on their website, but they looked at what are professional investors doing with China, and so they looked at 335 active funds that have a global mandate, and those funds have about 1.2 trillion, and 25% of those funds had zero China. And that's with like KWeb is up like 50%, and they have zero China. And that's because the geopolitical narrative for a US professional investor makes China uninvestable. Like the media narrative and the geopolitical, that if I'm a portfolio manager, how do I walk in and say, I'm going to buy China? And it's like, well, no, the Wall Street Journal and Bloomberg News are telling you like World War III is about to happen, or and you can't. If you're a pension, sure, you have an MBA or a CFA, but your board of directors, probably gets their China news from Fox News, and that's part of why I think this, if we can get this positive path of the US and China of actually doing a deal, Trump will change the narrative of China in the US. And that's a big pool of capital. Um, Regardless of whether or not other institutions are going to move a lot sooner. And that's where I think people really underestimate, the outcomes of this positive path, really about a huge pool of capital, which is U.S. institutional money coming back into China. But I mentioned I was in D.C. last week, and you know, you know, the political view of China is toxic. I mean, it's really negative, and trying to meet with institutions in the area, you know, you know, you know, they wanted nothing to do. It was persona non gratis. And then I'd be like, oh yeah, you're out of China. Yeah, but your number one position's Apple. Like, yeah, sure. Like so there's a lot of hypocrisy, and yeah, that's where I think Bank of America's chief strategist at the beginning of the year, they put out a great piece. It was called "Sell the Hubris," or yes, sell the ego and buy the hubris. and sell the U.S. and buy China. And I think these numbers reverting back is significant capital coming back into the space, and that money's not going to buy PetroChina or ICBC. It's going to buy the growth stocks. That's my belief.
Makes a lot of sense. I'm inclined to agree. I think that chart on the right definitely surprises me, especially when I look at KWeb and our China exposure in our portfolio this year. Before we kind of open up to the floor, maybe just zooming out a little bit, post the trade truce, markets rallied. Is this optimism too soon? What do we see in terms of the medium term?
It's unfortunately we can't predict the future. So the stock market is a outward looking probability, right? It's basically encompassing in all these different views, and I think the market reaction has to be noticed by Trump, that the market wants a trade deal, and certainly corporate executives who have his ear want a trade deal, and he'll negotiate a great deal for the American people, but ultimately, I think, and then I think from the China side, it's from being in my take is that China really wants to address the real estate crisis. I mean, I think that is, and so you if you can get put the trade deal, get that over with, you can really pivot on what you really care about, which is a real problem with real estate in China today.
Thanks, Brendan. We've covered a lot of ground from tariffs to AI and real estate. We're going to take this opportunity to open the floor for questions. If there's anything you would like to ask, Kenny has a mic, so just pop your hand up and he'll run over to you.
On another note, why don't I start for the audience, right? Because we already had some questions written. So I'll just start off an easy one for both of you. What is your outlook for the USD? And whether you think the rates will continue to slide? Brendan?
I mean, since the global financial crisis, the S&P 500 is up like 1,100%, and the US dollar is up like over 40% since April of 2011. So if US stocks robbed the bank, the US dollar was driving the getaway car. It's just this huge tailwind that helps US stocks, and I think it's also fueled the dollar strength versus the Singapore dollar or versus the renminbi, or obviously the Hong Kong dollar is pegged, but the dollar's outperformed every currency globally for the last 10 years. I mean, it's beaten the Swiss franc, you name it, the dollar's beaten it. And so as foreign investors, it's such a huge tailwind to have dollar denominated assets, and I think that can change, just because the interest rate differentials determines foreign currencies, in my opinion. And I think as the Fed eventually cuts, because the economy is slowing, that currency tailwind becomes a headwind. That foreign investors are going to run into a problem that, regardless of what U.S. equities do, if just because they're in dollars you're losing money, that's problematic. And then again, I think it's kind of funny. If you visited New York, out on 6th Avenue, they would have the dollar debt clock, and I noticed that they moved it. It's in between 5th and 6th on like 45th Street. I mean, and it's on the side of this building in like a weird angle, so it's kind of hidden, is what I'm saying. And the Chuck Prince, the former CEO of Citigroup, they said, with all these mortgages, I mean, this was in 2007, all this mortgage stuff, housing prices, like, why are you still doing all these home loans? And he famously said, well, you have to keep dancing while the music's playing. And at some point, there will be a Liz Truss moment of like this debt, all of a sudden people well care about it. And the thing is, the Doge stuff is great, but there's four, Medicare, Medicaid, Social Security, and defense, and increasingly interest on US debt. And there's no fiscal conservatives, and Donald Trump is not a fiscal conservative. And at some point, people will care. The bond market, the bond vigilantes will create a big issue at some point because of the size and scale of 36 trillion of U.S. government debt. Up from zero, 26 years ago, right?
Yeah, I'd say I'm inclined to agree. I think something I'd add as well, particularly for a Singapore-based investor group. Look, this year already we've seen the Sing dollar appreciate 5% against the US dollar. If we look at interest rate differentials, we can just map out where that's going to continue to go. And I think one thing for us that has been important, we have Sing dollar denominated portfolios that are generally invested in USD denominated assets and ETFs and so on, is we have to be thoughtful around that when we're going through performance. But certainly inclined to agree. You mentioned Liz Truss. 90 days does sound like quite a long time now. Do we have a live question? If not, or are there any more in the Q&A box? Oh, we have one over there.
Yeah, hi. So just on, my name is Mark. So just on China again, I mean, we hear a lot of anecdotal evidence of like, unemployment, empty malls, and in the cities and everything. Consumption spending is down. With this kind of economic backdrop, and then now there's tariffs. Even though it's brought down, there's still going to be 30% on Chinese goods. With this kind of backdrop, how could we see a meaningful economic recovery in China? And with that, a market recovery, you see. So, for this year and beyond.
Yeah, I think in January, I was in Shanghai, and Mark, what surprised me was the only thing anyone wanted to talk about in Shanghai was real estate. That this blue line, the top line is consumer confidence in China, and you can see even during zero COVID, consumer confidence actually stayed high, and what killed consumer confidence in China was the government implementing, they call it the three arrows, where they were, they were looking at the big levered real estate developers, the Evergrande and Country Gardens, but also the government was very worried about this infatuation with real estate investing that Chinese citizens have a very, very small amount of their savings in stocks, relative to bank deposits, the bond market, but particularly real estate. And this real estate crackdown, it's really materially impacted the household balance sheets. In Shanghai, everyone was talking about real estate. And I was like, yeah, but I see all these cranes. And people are like, listen, you're in Pudong, right? You're in the richest part of China, one of the richest part of the world. And, there's no problem building in Pudong, but you go to a tier 4 or tier 5 city, you're talking about a 50, 60, 70% drawdown from the highs. And if that's your retirement fund and you lose 70%, you're becoming exceedingly conservative, exceedingly fast. And that's why the government is made a real policy. Starting in September, you had this real policy shift towards stabilizing real estate, trying to incentivize, and you're seeing the tier 1 cities are actually showing an improvement. But that's like rich cities like Beijing and Shanghai and Shenzhen. And if you go to these lower tier cities, it's still a very, very debilitating situation. And so we've seen, the government, focused on real estate, and then they are trying to raise domestic consumption to offset, I think, they weren't exactly sure what Trump was going to do. So they've been stimulating to try to raise domestic consumption, but they've been doing it kind of incrementally. And I think now that Trump has kind of shown his hand that he was going to negotiate really hard, you're seeing an increased push. And I don't know if I have it in here. Yeah. Anyway, like, the level of savings in China is actually, and obviously the Chinese people save very, significantly, but it's way above trend, even for the Chinese citizens. And how do you got to get some of that money out of bank accounts and get it in? And so that's where you're seeing these consumer subsidies on auto, which includes EV and hybrid, home appliances, consumer electronics. And JD really spoke about that in their earnings on Tuesday, that their home appliance and electronic sales went up 17% year over year. So it is actually working, and obviously you see that in the auto and EV space, just with BYD and a whole host of others. So yeah, I think the government is very much geared to addressing this issue out of necessity, and it's arguably still early in that process. So it's kind of funny, like, because everyone asks about China's GDP. I'm like, well, it did 5%. The US did like 2. Like, 5 is pretty good versus 2. The value, now that China's economy is the second largest in the world, I'm like, the value of 5% growth is so much larger than 20 years ago when it was growing at 20%. But we're our brains are kind of wired on this percent change versus if we look at the value of change, it's a much better situation in my opinion.
Hi. Undervalued stocks, both markets, China and US. Which areas?
Well, in the the U.S., I mean, obviously the overvalued part of the U.S. market has been the Mag 7, the tech stocks, and there is a reason for that, which is the earnings per share growth, the revenue of those companies over the last 10 years has just been absolutely incredible. So this American exceptionalism is built on a fundamental case. The question just becomes, you know, just, with part of that thesis was you need these super high end NVIDIA chips. You're going to need more data centers. You're going to need more energy. And what DeepSeek did is basically say, maybe that's not purely true. I still think there's going to be a lot of AI in, globally. I don't think that's changing. It's just saying, like, maybe you just don't need to pay as much for it. So within the US, the real driver has just been, a very small segment. The average stock in the US has not done very well. And maybe you're going to see a little bit of a rotation there. Within China, the way we think about China is you have this onshore market, the Shanghai and Shenzhen, and kind of the Mark's question on, that market has done not well because that market is 95% owned by investors in China, and the stock market is like a barometer of consumer confidence, and it's basically saying thumbs down. So Shanghai and Shenzhen has really underperformed. The offshore market, where you have more a lot of these technology companies, You're starting to see this pickup since January of last year. So, it's self-serving and highly biased that I lean more toward China tech versus US tech just from a pure valuation. And the re-rating of China, I would argue, has a lot further to go relative to that. The expectations on the US stocks, it's just a high bar. It doesn't mean you can't exceed that bar, but if you don't, then you've got a real problem. And I think that's yeah, I think that's kind of been the issue of why, up until I think it was maybe on Tuesday, the US market was negative year to date. And some of that I think is investors just doing that math of, well, how can Nvidia, trade at 40 times sales, and just again that Alibaba at 14 times next year's earnings. I mean, that's a crazy disparity.
-5 in Sing dollars for the S&P 500.
Yeah, so two questions. So one is what's going on with healthcare in US? So I mean, it looks like even with optimism, that's probably one of those sector which continues to be in red, which is supposed to be a defensive sector. So maybe you can comment on that. I think second thing on China, I think as you mentioned, with this whole trust policy issues, China seen as not investable. Uh, Even this whole stimulus hasn't worked. But I think there's also one big thought that the data coming out of China is not very trustworthy. So you being a China expert, how do you see data coming out of China? How do you look at it? Do you trust it? And what you think will change, the China curve?
Yeah, on US healthcare, it's an area where I think there was a lot of optimism that Doge, that there's a lot of fraud and waste. And I think President Trump brought up a good point. Why do Americans pay 5 to 10 times more for the same drug? And so I think there's a lot of scrutiny of the intermediaries that are tacking on a lot of costs within the healthcare system. And I think, the this unfortunate murder of this, United Healthcare CEO, some of the public reaction I thought was very disconcerting. I mean, this poor guy, was just doing his job, but it shows the animosity to, these big healthcare providers. And ultimately, I think there will be a strong examination of the amount of costs embedded in that system that leads to the US having the most expensive healthcare in the world, but not necessarily the best. I think that's why that's really weighed on the space in terms of the China's people's view is capital flows to where it's treated best. And when you crack down on internet companies, when you put online education companies out of business, there's a lot of global investors were on the wrong side of that. And we can rationalize why it was done. And then you throw in things like the real estate crisis, which has weighed on, domestic consumption in China. You include things like, zero COVID policy. And again, we can rationalize why these things were all done. I mean, there's a reason. It just from a investor perspective, it's just an added risk. But I do think the geopolitical is a very significant headwind that, following Russia's invasion of Ukraine, it only raised, what's the China-Taiwan endgame. And, I think the supply chain issues during COVID, raises this issue of, what are the things we really have a necessity, and, should they be made? So I think all of these issues, in culmination against the backdrop of just own US stocks. And you never lose. And I think that's where, that element is arguably changing a little bit. But then, investors are going to have to earn, China will have to earn back the confidence of investors, and people need to be able to make money there, and capital will flow back. I really do believe that, but there's significant, scar tissue, I call it. There's a lot of mistrust, but at the same time, I think it is happening. Last November, um, I saw Howard Marks speak here in Singapore, and he said, I'm a value investor, and so I like cheap stuff, and China's cheap, so I'm a buyer. And he said, we owned Evergrande debt, and when they defaulted, I got one of their buildings. Like Oak Tree now owns a building, an Evergrande building. So he was like, rule of law. He's like, they proved it. So it's a slow process, and I think the volatility in the space is something that you have to take into account. There's ways, I think, to mitigate that. You can harvest that volatility. You can take advantage of it, but you can also active rebalance. I mean, just, I know we're getting close to it, but one, I did meet, I was able to meet with an institutional investor while I was in Washington, D.C., who's owns us. And, he was like, it's kind of easy. Like, you buy stuff when it blows up, and then you sell it down. You buy low and sell high. And he was like, we've had this position in K-Web, and then the market really rallied, and so he's like, I just brought it back down to my original weight, and then it fell, so I bought more, and then it rallied, I brought it back down, and then I added to it, and then it rallied, and he was like, it's actually one of our best performing positions just by actively rebalancing this position. You sell the rips and buy the dips. But he, you have to, instead of chasing it, instead of chasing the returns, he's waiting for these opportunistic situations, which, I think, within the Syfe models, you're probably active rebalancing frequently, right? That's the last free alpha, right? The last free is, rebalancing really forces you to take profits, and ultimately this unique period of diversification not working because U.S. stocks were the only game in town. If that's over, I think it brings back asset allocation, which arguably didn't work for a long time.
I think we have time just for one more before we wrap up.
Can you give some feedback about the automobile sectors versus the BYD, Tesla, and the Toyota, and all, how they are performing? How you see BYD playing a role in destroying the key players market?
Yeah, I think I think it was December of last year. I went to Shenzhen when I met with Tencent, and then went cross town to BYD, and they would not let me drive a car, which I was kind of disappointed. They've got this big showroom where they have all of their models, which are based on demographics and how much they cost. So you have the $150,000 SUV, and then all the way down to their version of like a VW Bug, and so it's a fascinating. I mean, it's a exceedingly well run company. When I met with them, they were like, they're like, since 2018, they're like, our revenues doubled and the stock is flat. Or it was 2019. And I was like, well, listen, in 2018, when the world discovered BYD because of Buffett, BYD went up like 250%. So I was like, you got to put it in But I was like, listen, you're a Chinese company, and investors don't own China. I actually had this exact same conversation with Tencent's management. They're like, we're doing so well, but the stock isn't doing anything. I was like, well, you're a Chinese company, like, no. So BYD, I think ultimately, is a real winner. And I think they do face extraordinary competition within China. That every provincial government has said, like, oh my gosh, look what the Shenzhen government did. So we're going to replicate that, and that overcapacity issue is a potential issue for BYD. And it's interesting that even yesterday, the government actually, they called in JD and Meituan, where JD's like, we're going to do restaurant delivery, and we're going to subsidize it. And the regulators actually said, we're not going to let you destroy Meituan and yourself. Like kind of like what we saw with Didi and Uber in China. They basically bankrupted themselves. And I think the Chinese government is getting a little bit of aware of, like, it's great there's other EV makers in China besides BYD, but we can't let them kill a leader. And I think BYD and CATL, the battery maker, I really do think those are, kind of must own stocks, or, hold them within a fund or a strategy. And I do think that an underappreciated element of what this U.S.-China positive path could be is, BYD already has a factory in the U.S. They don't really publicize it, especially under Biden. It's in California. It's outside of Sacramento. They make EV buses for the state of California. But it shows a Chinese company can manufacture in the United States. And if why wouldn't the U.S. subsidizes Japanese, South Korean automakers, if it, or German automakers, why not let a Chinese automaker in the United States, or at a minimum, allow them to JV with Ford and GM, and CATL wanted to do that, and Biden said no. That in January, the CEO and the CEO of CATL said, I offered to build a factory in Michigan, and the Biden government wouldn't let me do it. And so I think there is an ability and desire for Chinese companies to actually manufacture more locally. BYD's building a factory down in Brazil. NIO is building a factory in Hungary. So it's feasible, and I think that's that element is really underappreciated. That, and for the Chinese companies, they want to be outside of China. Because your supply chain problem driven by zero COVID was their revenue problem. And so, the China plus one strategy is really driven by Chinese companies going to Vietnam or Indonesia, Malaysia. I don't know. Aman's going to get married. I'm going to out him here. I'm going to take some liberty, but Aman is marrying a woman from Mexico City. And when I actually I was in Mexico City, and I walked into, it's called the Sheraton Angel. It's right near the big central square in Sheraton. And I literally walked into the lobby, and every person in the lobby was an Asian. And, I went to the guy at the desk to check in. I was like, what the heck is going on? I was just like, there's literally 150 Japanese, South Korean, Chinese, Singapore, Hong Kong. I was like, what is going on? And this was like 2-3 years ago. And he said, because of Tesla's factory in Monterey, these are all Japanese, South Korean, and Chinese auto and auto parts makers coming to build in Mexico. That because they couldn't get their stuff to the US, they're going to put their factories up in Monterey, and that way you can just hop over the border. And so again, I think it's why I'm just really hopeful this positive path takes place, and you could see some things out of the ordinary. And at the downdraft, I would say one, it shouldn't matter because non-US investors are already reallocating back into the space, and at a bare minimum, Aman will have a great wedding in Mexico City, and we should all celebrate that.
She'll be thrilled she came up. A Syfe client long before I worked here, but I don't think she's shown up. She was threatening it. We're out of time, so we won't be able to go to the BYD showroom a little earlier on this road. But if this was a morning event, maybe. Before I close and thank Brendan for his time, just wanted to share some of the ways that you can access China and KraneShares through Syfe. Of course, we covered our flagship core portfolios. They have exposure to China and indeed K-Web, which Brendan talked us through earlier on. Within our thematic portfolios as well, we've partnered with KraneShares, and we're very thankful for that partnership on our China growth portfolio. And of course, on our brokerage platform, all the KraneShares ETFs are available. With that, Brendan, thank you for your time today. Thank you to the audience for your participation. And I believe dinner's been served.
Okay, well, thank you, Aman, and thank you for everybody. And certainly, we should work on the Syfe KraneShares BYD visit. We're happy to arrange that.
Expensive here.